Joining us from Capitol Hill, Democratic Congressman Robert Andrews of New Jersey and Republican Congressman Ed Royce of California, who, by the way, is on the conference committee. So, Representative Royce, I'm going to start with you as a result. The most controversial, most concerning aspect to Wall Street right now is Blanche Lincoln's amendment, which forces the banks to spin off their very lucrative derivatives desk. Is that in? Is that going to stay, or is that going to be out?
We don't know the answer to that yet, but of course for 90% of American businesses that use derivatives to hedge against risk, this would create a great deal more volatility in the market. This would hurt their business model. And I think there's the wider question as well in terms of American competitiveness, what that would mean to the U.S. So there are lots in abeyance as we wait to see how this will be resolved between Senate and House conferees.
Representative Andrews, the consensus was that this amendment from Blanche Lincoln was in there to help her win her primary, and then once she did that, this was going away. There was a gentleman's agreement somewhere in Congress that it was going to be eliminated, and yet she won, and here we sit. It's still there. What happened?
Oh, I think people looked at some of the good ideas behind this. Look, there will be and there should be a derivatives market, a robust one, for the reasons that Ed said. But the issue is whether FDIC taxpayer-insured money should stand behind those derivatives. And I think because of the highly speculative and risky nature of this, that putting FDIC insurance taxpayer risk behind that is not such a good idea. So I don't know what the final result will be, but I think there was some sound thinking behind that amendment.
But you do realize that Senator Dodd's got this idea that the clearinghouses would actually be able to be backstopped, right? So in the end, taxpayer risk maybe is shifted to the clearinghouses instead.
Well, you know, but we heard before September of 2008 that there wasn't taxpayer risk for a lot of moral hazard guarantees that wound up costing us an awful lot of money. So there's a concern here that what starts out as an implicit risk becomes a very explicit taxpayer cost.
Congressman Royce, we just talked to three very successful, very influential money managers at the Morningstar Conference in Chicago. We asked all three of them whether or not they would touch any of the big banks and the big financials. All three of them said no, because of a lack of clarity about regulation and about the perhaps punitive nature of this regulation. Does it concern you at all that there's a lack of confidence in investing in America's financial institutions right now?
Well, there's a great deal of uncertainty, and that causes apprehension, and that causes, as you've correctly noted, capital to sit on the sidelines. I think going forward, there's also the worry that the capital markets will suffer as a result of this legislation. And I'm going to give you one example of a winner and a loser in the bill. Large firms, very large firms that are presumed to be too big to fail, when they are deemed systemically significant, they're going to be able to borrow at 100 basis points less than their competition. So the smaller companies are going to be losers in this. We saw this with Fannie Mae and Freddie Mac. When they had the implied government backstop behind them, they were able to borrow at a full interest point less than their competitors in the market and drove them out. Now, what has not been fixed in the bill is the FDIC can cover the creditors' costs up to 100%. So you're better off under this resolution authority probably than you are under bankruptcy. Large firms get this advantage of this lower borrowing cost, lowering cost of capital, and that's at the expense of their competition. This is a grave structural flaw in the legislation.
Do you agree, Congressman Andrews?
I've offered an amendment to try to address this.
I think Ed has a lot of good ideas. His amendment may improve. I would just put a little historical context here. Go back and read some of the comments made when the Securities Acts of the 1930s were put on the books, and a lot of them said the same thing, that there'd be all this new burdensome, strangling regulation. What followed was the most prosperous period in the history of American banking because the market became more transparent and more clean. You started this segment by saying that I think Wall Street would win or lose. I think America will win because of better and more transparent regulation. When America wins, Wall Street wins because the country's more prosperous and the banks can become more prosperous under those new rules. And I think that's what will happen.
And there's portions of the bill which my colleague and I agree on, which bring about that transparency. The part that Republicans are concerned about is this resolution authority, which basically gives such an advantage to the very large systemically significant companies, and in our view will not be good for the market in general.
Could wreak havoc in the bond market, because if you're a bond buyer, you're going to buy or sell, depending on whether you think there's going to be a backstop.
But I believe it's also true that these larger institutions that would be subject to this lower lending cost pay a higher premium to help finance the entity that would be the backstop. So there's a risk calculation and underwriting takes place that takes that into account. The smaller institutions would not pay that premium.
Congressman, thank you so much.